Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. The topic today is debt funds. And to answer all the issues related with it is a CEO of Value Research, Dhirendra Kumar. Dhiren, we welcome you.
Thank you.
There's been great turmoil in the market because of the debt funds. What should an investor do? How would you define the situation? And should one have it in the portfolio? These are some of the questions that keep coming up. So let's go one by one. What's your opinion on the way the debt funds are behaving these days?
Yes, there has been some surprise on debt fund, and understandable. We have discussed in previous episodes of this hangout sessions, and this will happen. One has to really understand the sense of, one should have a sense of magnitude, the scale. When something hits a headline of economic times, we think that, okay, the world is crumbling. It is not so. The scale of problem is small. Okay. Of course, that scale of problem might be small, but it could be an investor's 100% money invested in the fund, and even that small problem might have a very disproportionate impact on his savings or investments. But let's look at the inevitability of debt. One is that you need to put your money in fixed income simply because it is relatively much safer. Perceived safety as well as safety by design. Markets can go crazy about equities, not in fixed income. Fixed income, you have three things. How good is the company? Will it repay your principal and interest? And that instrument carries a interest rate. And it has a defined tenure. So all the problem in fixed income will get over in a defined period. Now we have had this problem, but inevitability of fixed income, you need it. You need fixed income. You need debt for two reasons. One is that it provides stability to your investments. So, and it must be embedded as any allocation. We keep talking about it. We tell investors that even if you are investing in equity, start with a balanced fund, because 35% debt allocation in a balanced fund will provide you stability. If you're looking for income, look at equity income fund, so that 35% equity will ensure that it has the potential to match inflation or beat inflation better, but 65% will provide you reasonable stability. So one is that you need debt for stability. The other is that for predictable goals, for investing for 2 years, 3 years, 4 years and when you need the money in foreseeable future, that money has to be in fixed income. Now, the fixed income funds are of various kinds, but before fixed income, most Indian investors are fixed depositors. That is a debt. That is the first level of debt. Your PPF account is a debt, is a debt investment, which you lend it to the government, or the post office MIP, which is another popular thing. So if you look at this will be this is the mainstay of Indian savers. This is where they invest. And the problem of all these fixed income yielding, government backed or deposits is that they don't give you the tax efficiency. They are not liquid, and also they are reasonably safe. A good number of them are very safe. But the moment you venture into a territory where you are trying to look for higher fixed income return, you get into a very sticky territory. Your principal and interest repayment could be at stake. Lower rated investment. We have seen it with fixed deposits of many companies. They just go bankrupt, and you don't have access to your money, and all that lending is all your the money which was invested was unsecured. So in that sense, mutual fund still is they get you the tax efficiency. It is liquid. And then comes which one to get into. I think investors need to really narrowly define what they will not be investing in, because that is the way to approach it. Be extremely cautious of it. You need fixed income funds. You need to invest in debt. Okay. But this crisis should not be a opportunity to avoid it altogether.
Okay, what I hear and what I decipher is that don't throw your debt funds out of the window.
Absolutely.
So you need to have them.
It's useful.
It's useful.
Important.
But for what reasons? For What reasons? Of course, you mentioned about the fixed deposits.
Liquidity.
Liquidity
Tax
and
efficiency.
favorable taxation and also diversification and higher return.
Higher return. So, these are good enough reason. And such situations like no return on your 2-year investment, 3-year investment should not create a situation that you avoid a good thing altogether forever.
So how does an investor go about it? How does one invest in debt funds in a given scenario? Are there ways in which one should?
Yes,
First
absolutely.
and foremost, I think one should understand what the problem is, understand what the risk is.
Absolutely. But it is very important to understand the risk of the debt funds. And most investors, they get carried by, once again, the perpetual problem that we are chasing past performance, what has done very well or extraordinarily well in recent past. We try to ride it. And that is where you assume a risk. And particularly fixed income funds, they turn around when you least expect it. I have seen it in the last 15 years, ever since the gilt funds were created, the long-term gilt funds. They are the set of funds which, if interest rates are going to go down, then those funds appreciate very handsomely.
Okay.
Because only the government securities are available with long maturity dates. So, longer the maturity, interest rates goes down by 1%, 2%, they can potentially go up by 4%, 5% if it's a 15-year, 20-year bond. Okay. So, for those kind of gains, and when an investor sees those recent performance as, 15%, 12% return, they invest, and then inevitably we see that, the tide has turned, the interest rates outlook has changed, and then they are hit with a loss. Don't chase recent past performance, rule 1. The other is that don't get into any of the exotic things. Liquidity is very crucial. Your ability to take your money back anytime with fixed income. So with that, there are 16 kinds. This industry has, also gone about complicating. For understandable reason, a large sales force has to be in the market, and, they try and craft products which are very specialized. In fact, now SEBI has defined 16 kind of fixed income funds. It's very hard for me to explain
16
it.
Is too
16 is 16
many.
are too many. Besides 16, you have FMPs. Besides 16, you have many kind of hybrid which are dominantly fixed income. So there are 16 kind of open-end debt funds. Most investors should give it a pass. Most of them. For most investors, 4 kind of funds are useful, and look at them very closely. Money for few days and few weeks, liquid fund and money market fund, they are good enough. Don't look at, because you get little more than your short-term deposit rates, substantially more than your savings bank account, and it operates almost like that. Get your money back anytime, and there's no exit load even for an overnight investment, and take your money back anytime, and reasonably safe. We haven't seen, except for one liquid fund, which faced a decline in value. We haven't seen otherwise generally. Okay. They have generally done well. And you get little more return than your savings bank and short-term deposit rate, and money is absolutely liquid. Take your money back anytime.
So what you're saying
money
is,
for few months, consider ultra short-term bond funds and short-term funds, and that is it. These 4 kind of funds should fulfill all your needs, because what we have seen is that, most investors try to look at slightly higher return on capital, and they put their capital at stake, which is a very undesirable thing. Fixed income investors, their primary concern should be that capital should be absolutely safe or reasonably safe. In mutual fund, it cannot be absolutely.
And on top of that, if you get something,
yeah, you always get a little more.
Yeah.
But having consistently, a high quality portfolio, and in case of fixed income fund, I would say that the rule should be never invest in the best performing fund, because if the best performing fund, the outlier on the higher side, will always be assuming some risk which is not visible. So maybe if you are looking at 1-year return, 3-year return, knock the one which is, top 3 funds, knock them. Don't invest in them. Simply because there will be a risk which is not visible, because risk visits you once in a while, and returns might get impressive continually. So that's a very naive rule. It might sound very unusual, but follow this and you will be saved of the nasty surprises.
So don't even look at the top 3, and don't go beyond the liquid, ultra short and short duration category.
Short funds. Yeah.
Don't go beyond that.
Yes.
Then you're safe.
then you are reasonably safe and you have access to your money anytime.
Okay, what are the circumstances which an investor should avoid or not should avoid taking a risk? How do they decide which money to invest in debt fund or not?
No, as I said that these 3-4 kind of funds are appropriate for even your critical money. But don't try to, because unless it must be worthwhile, it must be relevant. Assuming that, your money is idle for just a month period. And so you have option that the money lies in your bank account and you will earn 4% or 3.5% in state bank on your savings bank account. If you put that money in a liquid fund, you might make 6.5, 7, or it can well go up to 8% as it has happened in the last 1 or 2 years. Now this differential of 3.5 or 4% to 8% for 1 month will be how much? If it's a lakh of rupees, then and for a full year you earn 4,000 rupees more. So for 1 month it will be 4,000 over 12. Yes. So for 480 rupees extra, something like that.
Putting your base amount.
Why do it? So just see if it is worthwhile. If it is 50 lakh rupees, the money with which you will buy a house, and you are on your house hunting, or you are on the lookout, and the down payment, maybe that money could be lying there for 2-3 months. Maybe put that money in ultra short term bond funds. Avoid the top 1 or 2, 3, because the best performing, top 2 or 3 by return in recent times. Because avoiding the best performing ones, I think will always save you from the inordinate risk which some funds might.
I must say, I find that very intriguing, that mantra that you're giving, avoid the top 3 returning funds.
Yes.
So,
because what I found
is
that...
I want you to elaborate a bit more on that, if possible.
Return comes with risk. And this is something which one should...
yes.
And your primary goal should be to avoid the risk.
Okay. So, understand the risk first, and is it worth getting a few rupees more and jeopardizing your main amount of money? Think about it and then decide.
It's also, one has to look at it that, that little extra return will not make a huge difference to your life. But exactly. if you are hit by that risk, it will be a breaking point. Yes. So if you hit it off, you don't make something meaningful. So the trade-off is just not worthwhile.
So hope you understand that. Avoid the top 3 funds that give you the return when you are into the debt category. We move on to the Q&A part of our program, and the first question is from Gurminder. And Gurminder writes, I have a lump sum of 5 lakhs and would need it after 3 years. Currently, I have invested it in a mix of liquid and ultra short duration funds. Should I move it to the hybrid category? Which category among hybrids would be suitable?
It entirely depends on what kind of goal after 3 years. If you need the money after 3 years, do you need whole of it? Or is it a negotiable goal or a non-negotiable goal? If it is needed for something which you definitely need 36 months from now, then you don't need to do anything. You are good. You are well. You have invested your money well in fixed income fund, which will give you predictable return, no surprises, and in 3 years time frame, it will be better than your deposit. Maybe if it is little over 3 years, then it will also be more tax efficient. All your income from this investment, which will be of the nature of interest income, will be treated as capital gains and you will not be liable for taxes. So that apart, if it is for a negotiable goal, maybe you need it in a period of 3 to 5 years, you need to spend it on something, maybe all the money may not be needed, then you can well consider a small part of it. 2 ways to approach, hybridization of your investment. One is to, consider a small equity allocation fund. That could be equity income fund. 10 to 15 or 20% of that money will be in equity. Remaining will be fixed income. They will also be higher yielding fixed income investment. So it entirely depends, negotiable or non-negotiable goal. That should actually drive your action plan.
So for example, if he wants to buy a house or something and he wants to give,
yes,
in that case,
it depends. You will start looking out for it. And there is a possibility you just might get a positive surprise too. assuming that you want that money in 3 years or 3 years time, and your hybrid fund investment with 10-15% allocation just turns out to be, because they can yield more return. And if we get lucky with the market, it can well go up to 12-15%, which can help you achieve the goal better. You will have superior, better return, and the downside is protected. Your 20% allocation to equity, even if equities goes they go down by 5-10% in a 3 years time frame, still you will not be out of pocket. Your fixed income return will be consumed by the equity decline, but that looks unlikely.
A little over 3 years will give him tax benefit.
Tax benefit. So no tax benefit. Yes, 3 years investment gets you that indexation benefit.
The next question is from Ronak, and he writes, how should I get to know if my debt fund has created side pocket for defaulted bonds?
If you have invested in a fund which has created that it's called segregated portfolio, side pocketing. So if an investment has been a side
which
pocket
we discussed a few weeks
back, and because that was a regulatory change that happened, and so the fund company will inform you, and you will be getting an account statement. You will immediately on side pocketing you will get 2 account statement. One which will be your main, which you can realize anytime, and the money which has been side pocketed, you will get another account statement that this is the money which is stuck, and it is subject to resolution of the the underlying debt, and you will get account statement and information on that.
Santosh has written in saying that, in which category of debt funds should I park my emergency corpus?
One is that there is a hierarchy of emergency money. If you have old parents, young children, put your 20,000 rupee in your locker. That's one. Then having 10, 15, 20,000 rupee in your bank account, which is accessible from the ATM card, is the second level. That if you have to just run to the hospital, you can pick some money on the way. Then this third level is you can well put that in ultra short-term bond fund or short-term bond fund, and you'll get your money in a day or 2 days.
Our next question is from Prathamesh, and he says, is it wise to opt for the weekly systematic transfer plan instead of the SIP, monthly SIP?
If you wish so, it's fine. But it doesn't matter over a period of time. If you're going to do your SIP for the next 10 years, next 15 years, then doing it weekly or doing it monthly, we haven't seen any empirical evidence. Yes, if you're apparently it looks like weekly averaging might work better, or markets are more volatile and you'll be able to capture some downside. But the real story is that as you accumulate, the market has to really go up over a period of time. Being methodical, being systematic, I think that's quite valuable.
Weekly or monthly,
monthly or quarterly or annual, because if somebody is making an annual investment and does that annual investment over the next 30 years in a tax saving fund, always in the month of February, he's a SIP investor, and you have been able to average it over a period of time, accumulate and not take your money out. So it doesn't matter. If you feel happy and if you think that you will stick to your SIP schedule with a weekly one, go ahead.
There's an advice that's being sought by Sunil, and he says, I had invested in a closed-end fund which is not performing well. What should I do?
Unfortunately, you can't do much because closed-end funds by design, you put your money and wait for the maturity date. And of course, most closed-end funds, they have been listed for the sake of, because SEBI laws mandate that except for, capital guaranteed funds, every fund must provide for some interim liquidity. That is why they are listed, but they are hardly traded. And even if they are traded, then you will get much less money than its performance. If the fund you invested was, at 10 rupee NAV, and the NAV has gone up to 20 rupee, but it's not satisfactory or it's not doing well. And if it is listed, one, it will not be traded. You will not be able to sell it in the market. If you are able to sell it in the market, then you will not be able to sell it at 12 rupees. You will be able to sell it for 8 rupees or 9 rupees. It will be at a steep discount to NAV, if at all. So you don't have a choice but to wait till its redemption and take a lesson that never invest in a closed-end fund.
Is it a good time to invest in a small cap fund with a horizon of 3 years? I'm not asking. This is from Subhashish.
Yeah. Maybe not, because and that is not an answer. The thing is that small cap funds are not meant for everyone. They are meant for somebody who has, because if you don't have the experience and if you don't have the temperament, they are not meant for you, because when the market goes down, uh, small caps are struggling. They did very poorly in 2018. They're the worst performing fund, and they might continue to do poorly. And if you invest in a poor market when they are not doing well, you generally end up making more return. You end up benefiting from that. But don't lose the context in terms that small cap should be a small part of your portfolio, not more than 20-30% for most investors. You must have the experience, and you must have a temperament that it'll go down every month by 5%, 2%, 3%, and you'll continue investing. You must have 5-year and more longer time frame. 3 years time frame is just not good enough even for any generic multi-cap equity.
Sure. Okay, Srivat says, I'm retired and looking for a monthly return from my investments in mutual funds. Should I opt for monthly dividend plans?
No. Mutual funds dividend are no longer efficient way of deriving return from mutual fund. They are very tax inefficient, because your need for income is monthly, and your need for, and the quantum of income that you derive is entirely a function of how much money you have in all. So invest your money in a growth plan. Choose a withdrawal plan. A systematic withdrawal plan will ensure that you are taking the money to the extent you need, and at a periodicity of your choice. So put your money in appropriate fund for this. It could well be hybrid funds or conservative funds, 4 to 6% withdrawal rate, and then your ability to revise it annually. So do your 1-year SWP based on your initial investment, and after that revise it depending on depending on the worth of the capital after that withdrawal. Because if you are investing, say, 1 crore rupee, I'm just for 1 crore is a large amount, but I'm saying 1 crore for ease of calculation. 1 crore rupee, and you are withdrawing 6%, which means 50,000 rupee withdrawal from a 1 crore portfolio. So 50,000 rupees per month withdrawal. And after 1 year, whatever be the worth of investment, assuming that 1 crore becomes 1 crore 5 lakh rupees, then you can increase it. That 6% of 1 crore 5 lakh rupees. So it will go up to 55,000, say 56,000.
Devendra has written saying, would it be prudent to switch from a non-performing activity managed fund to an index fund?
Yes, if you're sure that you can't choose a fund which will do well. But Devendra, I would like to tell you that 2008 was an exceptional year when index did exceptionally well and all other funds did relatively poorly. Most funds struggled to beat the index in 2018. But 2018 should not guide you to, because when I look at 10-year return, 5-year return, 15-year return, 20-year return, or any time period of 5 years and more, even 5-year return ending in 2018 was disappointing for most, for most actively managed fund. So that definitely, and the margin of outperformance of actively managed fund is definitely reducing. More and more actively managed funds are struggling to beat the index by a wide margin. But still, when I look at 5-year return, and in most years over the last 20 years, funds beat, except for 2018. Even on a 5-year SIP return, funds struggled to beat, because the index did exceptionally well. 4 companies in the index went up so dramatically, and all other parts of the market fell very dramatically. The small caps went down by 30-40%, and that is what a multi-cap. But I still feel that if you're a long-term investor, and choose carefully, choose a multi-cap fund, have some small cap, mid-cap allocation, that will generate you, and the averaging will work to your advantage. But if you can't do that, index fund is also a reasonable choice. Today you have index funds which are available, index ETF, the Nifty ETF is available at 10 basis point. That itself, the low cost itself is a huge advantage, because actively managed fund charging 1.5-2%. So they have to do 2% better annually to match that index fund, which is charging so little. So, and I also hope that some of the index configuration itself will change to enhance the return of investors on index. So, you can well consider that, but I still see that the good days of actively managed fund will linger for a while.
That was a useful discussion going on, and I was really enjoying it, Dhiren. But the time is running out, and we have to wind up today's program. Till we meet next time, make sure that you continue to invest and do understand your risks pretty well. Signing off, I'm Rajesh Lake, and with Dhirendra. Bye for now.